Welcome back to the Open Web Forum at CogX, curated by Fabric Ventures. For our final panel on DeFi, we'll discuss stablecoins, the differences, similarities, and which experiments are proving promising. Moderating this panel is Mike Dudas, VP of Business Development and Ventures at Paxos, where he is responsible for growth of the company's products and partnerships. Over to you, Mike.
Hi, thank you so much. Delighted to be here early in the morning, New York time, with a fantastic panel and group of folks. So today we'll be discussing stablecoin, and the group of folks that's joining me is Freddie Farmer, former head of DeFi at Wintermute Trading, Pablo Veyrat, core contributor at Angle Labs, Gustav Arentoft, contributor at MakerDAO, and Julien Thevenard, associate at Fabric Ventures. A really incredible group of folks with a varied range of experience, from trading to working at decentralized foundations. So, as a quick level set, we figured I'd give a quick introduction to what a stablecoin is, but ultimately it's an asset, a token that's issued on public blockchains with a peg or a reference tie to some other asset or currency. So the most common stablecoins are digital representations of US dollars, but there are stablecoins for other large currencies, including the euro. There are stablecoins that are backed by gold, a commodity, and these stablecoins are really unique in that they're issued on public blockchains rather than typically Ethereum, but increasingly other chains as well. And they're 24/7, 365. They're transparent. They can move between folks simply by sending from one mobile wallet to another. They're really an interesting and novel form of money. But today we'll be discussing how they're used in DeFi, which is decentralized finance. You guys have been on a number of panels talking about this. And they're really the critical underpinning. Stablecoin growth, stablecoin usage has grown from less than $10 billion or outstanding 6 to 9 months ago to more than $100 billion outstanding at the current moment. The largest stablecoins are Tether, USDC, and Binance's USD. Those are the largest centralized stablecoins, or I shouldn't say centralized, fiat-backed. And then there's sort of crypto collateralized stablecoins like MakerDAO and other decentralized and algorithmic stablecoins as well. So would love to start with a question to level set with the audience. What are the types of stablecoins used in DeFi? And I think Freddie, given your experience in Wintermute, it would be excellent if you can kind of walk us through the different types of stablecoins.
Yeah, sure. So, as Mike alluded to, stablecoins are kind of crypto without the volatility, and the way they do this is by pegging to a kind of a reference asset, either by being over collateralized, which kind of prevents the downside risk of the collateral that you deposit against that stablecoin, or fiat collateralized, which is pretty straightforward. Put $1 in a bank, get $1 on a blockchain kind of structure. Now, fiat collateralized is probably the main bucket, as Mike mentioned, to Paxos, with Tether, USDC, and BUSD, and those proliferate all across DeFi, mainly used for the purposes of gaining financial leverage on DeFi tokens themselves, but also kind of as staking collateral to help kind of the cogs of DeFi function. So you can do a lot of very basic financial primitives in DeFi, including just general exchange, derivatives, insurance, and stablecoins naturally make for a great example asset to provide liquidity, for example, for the use case of exchange, or to stake as insurance against the risk of a financial product going awry. Another type, so that's fiat collateralized being the main one, $1 in a bank, for $1 on a blockchain. You gain the transparency, the remittance capabilities. Then there's crypto collateralized. So in the case, Gustav here from MakerDAO, probably the original crypto collateralized currency. As I alluded to before, you may deposit ETH in a smart contract in DeFi. It's priced in dollars using like an Oracle price. And you're able to borrow against that collateral. It's not too dissimilar from like a traditional analogy. It's kind of Bretton Woods era a dollar. So you deposit gold at the bank, you can borrow the bank-specific $1 and you pay it back and you get your gold deposit back. Very, very simple, but permissionless, 24/7, 365, and fully transparent to everyone in terms of both the risks and who's using it and when. Now, that would be very easy if it stopped there, but I think the most exciting thing in general about the stablecoin space is probably heading towards the algorithmic stablecoin space. So I see this as the kind of the econ 101 here in the UK, kind of GCSE econ, is very much that monopolies are potentially bad. They kind of have bloat and they don't necessarily innovate. And central banks, whilst they do a fantastic job in terms of how efficient they are, because that's what centralization often gives you, the corollary to that is they kind of can be slow-moving beasts, limited access to data, and don't necessarily have the incentives to innovate very fast. And the algorithmic stablecoin space is the opposite, which is in essence what rules. What rules and incentives can we bake into a transparent blockchain-based system to create stability? And sometimes that's the attempt to peg to the global reserve asset, which is the dollar, or sometimes it's just just to kind of evenly target even purchasing power parity. And these are just like live, and Pablo's going to be the best because he's actually creating one of these. But there's almost far too many to go into. But maybe we'll touch across a few maybe that myself or Wintermute have helped with in the background.
Yeah, sure.
Pablo,
Sorry.
quick question there. So kick it over to you to a little bit more on algorithmic stablecoins. But how do you see that? Are they being used in DeFi today? That algorithmic bucket, and if yes, tell us a little about it. If not, what do you think it'll take to get there? And what are you working on to help solve that?
Yes. So in DeFi, actually, to see if they are used, you just have to look at main DeFi protocols like Compound or Ivy to get an idea of the spread of algorithmic stablecoins in DeFi. I think the total supply of DAI, which is the main algorithmic stablecoin, is pretty outstanding, and it shows that it has real use cases in DeFi. So the question now is, and the questions of Freddie, and then I may come back to a question of sure. What are the real use cases of algorithmic stablecoins? Yeah. You want it? Okay, no. So the question is, how do you make an algorithmic stablecoin stable? So Freddie, you mentioned the importance of having collateral, that is money or cryptocurrencies backing the stablecoin. The thing in crypto, when you are an algorithmic stablecoin, you cannot have fiat as collateral. So you need to accept collateral, which is volatile. And the huge difficulty when you are making a decentralized stablecoin, so an algorithmic stablecoin, it is that what is backing your stablecoin has a value that varies through time. And like in the Bretton Woods system, if you want your stablecoin to remain stable, well, it depends on the design, but you are better off with having a backing value, which is also stable. So you need to insure yourself when you are a protocol against the volatility of the collateral to make sure that you have always enough reserves. So one solution, so always enough reserves, is always to be put into commas, because some protocols, so there are two types of algorithmic protocols. Some are over collateralized, meaning that they target for more collateral backing the stablecoin. And some are under collateralized, meaning there is always less collateral backing the outstanding value of the stablecoin. So as for over collateralized designs, the example, as I was saying, is Maker's one. What they do is that they have a structure which is called a vote, where you need to put collateral in it to be able to issue DAI to the stablecoin. And you need, in your vote, you always need to make sure that there is always 150, I mean, it depends on the collateral you have, but you always need to make sure that there is always 150, that the value of the collateral is 150% that of the value of the stablecoin issued. And when you drop below this value, you get liquidated. And this is a way to ensure that you always have more collateral. In terms of under collateralized designs, the ones for which there is less collateral backing the value, the idea is to rely on governance tokens. That is tokens issued by the protocol that give right to vote, that give right to change protocol parameters. And the way this protocol works, I mean, I'm just generalizing here, is that when the supply of the stablecoin is too big, meaning that when the price of the stablecoin is too low, then governance tokens are used to buy back stablecoins. And when the supply is too low, meaning the price of the stablecoins is too high, then governance tokens are used to issue more stablecoins. So this is for the different designs. The question here is really volatility.
And we'll get into that, I think, as we start to talk about how they're used in DeFi. So the really interesting thing is just the complexity and the type of stablecoin, and call it like base currency used is incredible. Now let's get into let's just assume that we have a stable base currency. You have pegged to the dollar, pegged to the euro, either fiat backing, crypto backing, or through math and incentives, as Pablo is describing. How are these coins now actually used? How are they put to, call it, productive or economic use in decentralized finance? Gustav, it would be great if you could kind of start and just walk through a couple of the key ways.
Yes. So I mean, getting an overview of this ecosystem today is a little bit more difficult than it was, just a year and a half ago. But to give you some of the most basic use cases we have, as Freddie also mentioned earlier, we kind of like have the trading space. And I think like one concept here, which is quite interesting to grasp, especially when you're coming new into the space, is that you have these smart contracts that basically allows you to perform automatic actions depending on inputs from other places in that protocol, and also take custody of the assets and do things with your assets without you actually needing to do anything. So we, for example, have something called like an AMM, an automated market maker, where you're allowed to put assets into these pools where people can automatically trade against your assets. So, I think, one that's really cool if you're talking about stablecoins is Curve, where since we have so many different stablecoins now, people automatically want to, like switch between them because some of them are used more in other places than others. So, you have like DAI, which is, depending on like, not in total number, but like percentage of the supply is very, very used in DeFi. You have like USDT Tether, which is very much used for trading. You have USDC, which is, somewhere like in between. But these different stablecoins have like different properties and use cases. So Curve is basically like an AMM, an automated market maker that allows you to deposit your stablecoins into it, and then people can trade against it. And in this protocol here, you actually don't have any volatility risk, because all the stablecoins are the dollar. So this is like a way of you using a smart contract to basically hold your assets, allowing you to provide automatic liquidity to other people who wants to trade against these assets. Another really, really big part of the space, which is where we see currently the most assets within DeFi, is the borrowing and lending markets, where we have like the three major protocols, which is Aave, Compound, and MakerDAO. So at MakerDAO, we are only a borrowing protocol, so you borrow DAI against collateral. But in Compound and Aave, what they basically have created is a highly efficient peer-to-peer lending and borrowing market. So, if we go back and we see some of the early peer-to-peer borrowing and lending markets back in, like the early 10s and up to maybe 2012, 2013, we compare like their early growth rates to like what we have seen in the DeFi peer-to-peer lending markets. The use case has really, really proven itself, and they have, billions of dollars inside these protocols right now. And what they basically have is they have a smart contract in the middle that matches people who wants to lend out their capital to people who wants to borrow the capital against the collateral. So in these protocols, you have the collateral as kind of like the insurance that, if the counterparty doesn't pay you back, you can liquidate his collateral and, you can get repaid anyways. And this is, like a huge part of what I would say is like DeFi today, and a way for like a lot of retail users, I think, coming in, if they want to earn 4, 5, 6% on their dollar deposits, is a great way to kind of like get started, and it's very competitive to like what we see of the rates in the traditional world. On top of all of these protocols here, we've also within, it's actually, I think we're coming out almost on the yearly anniversary for when Compound started distributing comp tokens. But another really, really interesting thing about this is that we have seen these protocols actually go in and say, you know what, if you provide liquidity into us, we will give you a share of the system. So, you know, both Compound and Aave, Maker unfortunately doesn't do it yet, but Uniswap and Curve, all of these protocols, they say, if you participate here, we will make you a part owner of our protocol. So they distribute tokens to people using these protocols. And I think this is, you know, like an incredibly exciting thing, which is, you know, again, really, you know, like a testament to the programmability of the money that we're using here.
What's the common term for that? What do folks call that typically?
So I mean, I think like if you want to have like the general term, I think it would probably yield farming. So, you know, people are going in and they're, you know, like farming this yield in these protocols. And of course, it ranges all the way from, you know, like the very, very early yield, you know, where you have these like very experimental protocol that distributes a lot of tokens to people because they really want to attract liquidity. And then you have like the other end of the spectrum, which, you know, like Aave that says, you know, like, we have a lot of users already, but, you know, let's sweeten the deal a little bit and give them a little bit of more yield on top of what they already are earning from the deposits.
Yield farming is done across both the borrowing, lending, and the trading AMM protocols, right? It's a catch-all term for when you're sort of getting yield as a return in the form of tokens.
Yes, exactly. And it's also used in, you know, like insurance protocol, perpetual trading protocols, derivatives protocols, synthetic asset protocols. It's really like wherever you have a protocol where you have a product and you really want to make sure that you have enough liquidity in that product. Right now, the space is really involved into being like quite a bit more competitive in that sense, that people are, you know, needing to distribute, you know, share to people using them to attract as much liquidity as possible.
Yeah,
amazing.
I want to focus a bit on the yield farming side, because I think that's one of the very interesting area of this space. Because as Gustav was mentioning, so we've got programmable money or programmable assets, and we can incentivize certain behavior in the crypto world. And so in any industry, you always have challenges with bootstrapping either the supply side or demand side of your marketplace, always this chicken and egg challenge. And so in the crypto space, you can literally pay people to come and try your product or come and provide liquidity, whichever the use case. So like in the lending market, like Aave, you can incentivize people to come in and provide liquidity for people to borrow. And so by incentivizing people like that, you can bootstrap a marketplace really quickly. And unlike the traditional economies where you would pay potentially someone a marketing fee or you would give them a cashback, here you're giving them ownership in the protocol. So actually, not only are they getting paid to try the product, but they're also now an owner of the product, and they can start spreading the good word, etc. So it's really, really an interesting area.
And they're an owner, and what's also beautiful is that ownership can be transferred, you know, sort of instantaneously to someone else. Mark Cuban wrote about this yesterday, and it sort of changes the notion of these DeFi protocols necessarily needing to be, call it, profitable. You know, when you actually have this value being created, you know, via revenue, via fees and incentives that I can just transfer directly to somebody else to realize the benefits of my position, you know, even if I'm, you know, not capturing, even if the protocol itself isn't necessarily optimizing to capture profit directly. Getting into stablecoins a little bit more, you know, Pablo, would you like to maybe talk a little bit about, you know, kind of where yields are generated,
yeah,
and
sure.
whether they're and also I think, you know, hey, are they sustainable? And do they ultimately provide a better consumer product, do you think? So sustainable, you know, where do yields come from, sustainability, that kind of thing?
So I think to answer the question of the yield, you have to look at lending markets. When you get yield on a stablecoin, is that you lend your stablecoin, and so the yield you get is from the interest of people who borrow your stablecoin. So where do yields come from? Yields come from borrowing stablecoins. And so the question is, why do people borrow stablecoins on lending platforms like Compound or Aave? There are several answers to this question. I think the main answer you can find to this, and then the main answer of why can you find yield on your stablecoins, is that there is some demand for leverage on blockchains. People want to be able to get the returns they would get if they had like their amount of ETH times, I don't know, 2 or 3. And so this is leverage. So how do you get leverage on chain? You deposit in a lending contract ETH, and you borrow DAI, you borrow stablecoins from Maker, Compound, or Aave. So yields come from people willing to get leverage, borrowing the stablecoins, and then swapping their stablecoins using automated market makers like Uniswap against ETH, meaning from 1.5 ETH, you can end up after borrowing with 2.5 from 1.5 ETH, you can end up with 2.5 ETH, meaning you are leveraged. So the question of the sustainability of the stablecoin is really the question of the sustainability of the demand for leverage. I think high yields are sustainable in bull markets when everyone wants to get leverage and when there is a common market conviction that the price of ETH or the price of other collaterals are going to increase. I'm not sure they are sustainable in this is again my own opinion. I'm not sure high yields for stablecoins are sustainable in markets where there are no liquidity mining rewards, no governance tokens given to people contributing to protocol, and in markets where everyone thinks the price of crypto is going to stay the same or to decrease. So this is my answer to the question of where do yields come from. Do they help provide a better consumer product? For sure, and they are really the main driver. I mean, personally, that's what I think, the main driver for the growth of stablecoins. Stablecoins have been growing so quickly this year because the price of collateral have been growing so quickly, and so this bootstrapped a demand for leverage and hence an opportunity to get yield using stablecoins. But I'm not sure it will grow as fast if the market conditions are like a bit bearish.
Incredible. Yeah, it's I can say as somebody at Paxos, working on our stablecoin product and our crypto brokerage product, one of the greatest questions that we get, and from a consumer perspective, I would say, my kind of bias is today, this is a bit of a sort of insiders, highly technical, financial market, sophisticated folks, game. But I do think we're moving towards a point where, because of stablecoin, there will be real world application and usage. Yeah. Examples are, we're talking, and many others are talking to neobanks. You saw Circle as well, introducing a treasury yield product. But specifically, you can imagine somebody having a balance at a neobank, and instead of holding fiat dollars, they might actually convert into a stable coin that then that neobank is doing, and the consumer opts into it, is aware of kind of the risks and the potential yield that they would get by holding in stablecoin and letting their dollars be put to work on behalf of them in DeFi. And then potentially generate, call it 2, 3, 4% yield. I don't think it's going to be the 8 to 10% that we've seen historically in perpetuity. It's going to be much lower. So that's exciting to me. Anybody else want to talk about stablecoin, or I can move to sort of the next question?
A quick one on the yield. Just a quick one, and then Freddie. A quick one on the yield. I think another reason of another source of yield is probably the fact that we have different, like we said in the very beginning of the panel. We have different versions of stablecoins, like the USD backed one, like USDC, USDT, the ones like DAI, etc. So different version of the dollar on the blockchain, which can be a bit weird if you're not used to this space. So what this means is, given there's different version of the same quote unquote asset, but with a different risk profile, there's arbitrage opportunities because some people only have access to a certain stablecoin, and maybe they want another one. Or some people want to have permissionless creation of stablecoins, so they prefer DAI. Sometimes they need USDC to trade elsewhere. You don't know. But so those need for trading means that there are some inefficiencies in the market, some arbitrage, and that creates yield as well.
Excellent. So really interesting. Since you just spoke, Julien, I'm going to throw this next question to start over to Freddie. Freddie, as we're thinking about kind of looking forward in DeFi, what are some new and novel use cases? I mean, we talked about two of the largest use, in sort of trading AMMs, borrowing and lending, yield farming. I guess a couple things. Do you see that growing? Do you see it going mainstream? And then what are some other ways that we might actually see stablecoin usage in DeFi, or that you might be seeing? And you can start, and others can jump in.
Yeah, I'm just. It's an interesting one because predicting the future is notoriously difficult.
Particularly when we're trying to predict what type of stablecoins will even be used, right?
Yeah. So look, I'm a. I think later we might do that. I'm sure there's usually a Bitcoin price prediction, but we're not going to be doing a stablecoin price prediction. But I would say, I do think that I guess you got to take a step back. That's not necessarily like stablecoin specific, but is more kind of back to the crypto and the blockchain element, which is like what the blockchains allow you to do. Well, they allow you, first of all, a lot of transparency. They reduce, there's a lot of, you reduce just a lot of middlemen. So a lot of businesses that were traditionally charged for sitting in the middle of a transaction because trust is required for it are removed. And so, all the corollaries you hear, often in the news of crypto is volatile, ergo it's not fulfilling that purpose, which it's very good at. Stablecoins are kind of the answer, so that you have they're not volatile. Your assets, potentially your wealth, is protected, and you get the benefits of peer-to-peer trustless action 24/7. That is just incredibly powerful and can be used in a whole manner of ways. Like, I think what I would say about like sustainability of yields, you kind of have to ask yourself, like, is decentralization itself, like valuable? And I think a lot of people would say it is, because it provides the ability for censorship resistance. So, if, for example, any tyrannical state or even a corrupt actor within a trust-based system going rogue, then you see a downfall. Like you won't see it. And you kind of, I think maybe a good analogy in traditional finance would be it's basically counterparty credit risk. So if you're lending money to Apple's probably bigger than you as a bank. So actually, they should be getting better rates than you can borrow yourself from all of the other banking system. And it's only at those levels that you start to see that kind of, wow, I actually need to think about the risk at this level of money. Whereas what you can do in stablecoins, because basically the blockchain ensures the security of them, is you can get rid of that. So like a simple example would be, a very small startup, I'm not even sure if it's still functioning, called Sablia, just allow you to stream micropayments. That was not really something you could do very efficiently prior. But if you were streaming micropayments from a producer to a supplier, naturally you basically reduce the credit risk, any kind of financial risk between the payment for the goods and the delivery of the goods to practically zero. So I think
that's sorry.
What's
really interesting about that one is that you're starting to get into, kind of DeFi merging with, call it, other use cases, right? Perhaps it's
which is what we need. It's absolutely what we need. It's lovely. It's lovely having leverage on crypto, which is naturally a growing space that does drive a lot of demand for yields. I think the two things that make them more sustainable in general are a base layer of requirement for censorship resistance. I think it's super valuable. You imagine any, it doesn't make sense. It's harder to think of from, sitting in London and New York, and we're all sitting in like MEDCs. But if you're in a war-torn country trying to flee, you can't take any assets with you. Like, you just can't. So I think once you get the adoption of kind of fiat on-ramps and off-ramps, which is currently the sticking point, remittance companies like Western Union, they just would be destroyed if on-ramps and off-ramps were actually made more efficient.
And I love that you're getting into that. It was sort of starting to get to, the segue was, okay, future uses of DeFi, future uses outside of DeFi, but it becomes more and more clear that, decentralized finance sort of
everything will be DeFi. We're just like early innings.
Maybe it's not the right word, but it's effectively, kind of lending, borrowing, and moving money, payments for goods and services, P2P, remittances, business payments, things you're talking about, collateralizing. First, it's going to be digital goods. You're seeing some emergent use cases like collateralizing, and using NFTs, as backing for loans. Does anybody want to start to comment on some of those emergent use cases?
So I think I just kind of like want to tie a little bit of some comments, right? So like at Maker, I think we were one of the first stablecoin teams to really have like a very, very focused business agenda and like a business development team. We've been working on that front for over 3 years now, and we basically we managed to manifest ourselves as actually quite a few weeks, we beat Bitcoin in the peer-to-peer markets in Argentina on volume, right? So we have really, been working very, very hard on, trying to figure out like how could we manifest DAI as like the problem solver in some of these emerging economies, right? And to pick up a little bit on like what Freddie said there, right? Like right now we live in a world where there's an incredible bias in the financial system, right? We see, the financial systems, they're very, jurisdictional, they're very localized, and they're biased against things such as, like who are you, who are your parents, what's your religion, what's your race, where do you come from, where are you born, and where are you now, right? Where what DeFi and stablecoin crypto presents in general is really like a global alternative, right? So whenever we're looking at some of these services here, right, it's completely unbiased, right? Anyone can participate from anywhere in the world, and they get the same terms, they get the same deals. And once we kind of like look at the structure of what that actually means, that means that we can be pairing people in like emerging economies who want to not get fucked by inflation, who wants like to earn a yield on a dollar, which typically is very difficult to achieve in some of those countries, right? I used to live in
America these days.
yeah. In Europe, we have negative rates right now, right? But I used to live in Argentina. We had 50 to 60% inflation the years that I was there, and it was super difficult to get dollars, right? We had to go to basically like fake storefronts, trade in back alleys, and so on. So what I really believe is that like this whole movement here really creates the ability for people to tap into a global alternative to their local financial systems, and if that global alternative will prove better services than what they get locally, the local systems won't be competitive against it, right?
Are you seeing that happening? Are you seeing that happening between wallets in a P2P way? Like how? Because it feels like Maker's really on the forefront of this, and that is truly decentralized finance. If folks are transacting from the wallets without necessarily hitting the bank regularly.
Yeah, I mean, we have seen a huge trend in the last like year and a half on the peer-to-peer markets really manifesting itself as like the major trading revenue like venues. We've seen the Binance peer-to-peer platform, it achieve like crazy volumes. I mean, of course, compared to like centralized exchanges where you have professional market makers, it's a different game, right? Because like in centralized exchanges, a lot of the trading is derived like automatically. But in the peer-to-peer market, every single transaction happens, and that is because like a real person exchanges crypto for fiat in a completely decentralized way. And this is like a trend we have seen, especially in countries with capital controls. So like Argentina, India has been pretty strict on like the regulatory front as well. So there we also see mostly peer-to-peer trading, and then we see some of the regions in Africa, especially in the West African region, also down around Nigeria. Nigeria has strict capital controls now. And this basically means that like people, they actually manage to find a way, even without like all the nice infrastructure we have in the Western world, where we can buy crypto within 30 seconds from Coinbase or Kraken or whatever. But they still find a way to tap into this, right? And this is
it's an incredible phenomenon, and frankly, in my seat at Paxos, I see global financial services and fintech companies working on all manners of products to help get basically if I can't be banked in a specific country, starting to think about stablecoin, Bitcoin, ETH, being deposited into mobile wallets, and then as you're describing, letting sort of the local peer-to-peer decentralized market work out, how that value gets exchanged and realized by the end user. So one quick question: do you maybe I'd just love one person to take this for like a minute. CBDCs, I genuinely believe, are probably call it a decade off in terms of real adoption. Do stablecoins go away when CBDCs arrive, central bank digital currencies, or do they coexist? Because I think that's important to the future of DeFi, that they stay around.
It's not an easy one to answer because, pretty speculative at this point. I think in certain areas of the world, the only real benefit of a central bank digital currency is versus a crypto asset like DAI, for example, is if you can actually spend it outside of crypto and potentially redeem it back to euro if you need it, or back to dollars. But realistically, if it's difficult to access that central bank digital currency and the only way to get it is to buy it, for example, if you live in Latin America, that's not great. Versus something like DAI, where potentially you store your wealth in Bitcoin, and now you can actually deposit that and borrow against it permissionlessly. You don't have to ask anyone. You can just create it, repay your loan anytime. So CBDC are interesting, and they're probably going to take a bulk of the volume because of the easiness of redemption. But I think there's still a need for permissionless creation like DAI, which are potentially even stronger versions of money.
Exciting.
Yeah.
So we just a quick, it'd be great, for those who are interested, what's maybe one thing or one prediction about stablecoins that you have for the next few years, or something that's kind of most exciting to you? Pablo, we'll start with you.
So first, I think that new protocols will emerge. So at Angle Labs, we are working on our own stablecoin protocol, new design. So Maker has been really innovative, but I don't think we are done with stablecoin designs. New incentives can be found to peg a stablecoin to an asset. So that's one thing. I also think that stablecoins pegged to other currencies are going to emerge. The market is mostly stable USD. There is almost no liquidity in stable euro, although there is a huge demand for it. So I think the ecosystem will will push for new stablecoins. And I think that one last thing, that stablecoins pegged to other instruments than currencies will appear. So you can have stablecoins pegged to securities, to Tesla share. You can have stablecoins pegged to imaginary assets like temperature in New York. And this is a new types of stablecoins I think will arrive.
Excellent. And we do Pax Gold at Shill at Paxos, and that's the first of multiple commodities that we'll tokenize and peg. Freddie.
I think going back to your point before on CBDCs, they're likely to be able to effectively they have a mandate to kind of like enforce based on jurisdiction their usage. Right. So it's like obviously they're going to be huge because stablecoins, despite their incredible growth over the last 2 years, are not there yet. I say the biggest risk sits in the fiat-backed stablecoins in principle, because if that mandate does need to be enforced, then the easiest thing for them to do is to enforce it against just deposits, like just standardized deposits. That being said, there may be a better way for them to work, more closely with their current kind of the financial institutions that they already are close to with regulating. So we might not see that, but I do think the risk clearly sits there more because crypto-backed or completely algorithmic, fundamentally it doesn't matter at all. The only thing
I agree, Freddie.
Supply and demand.
Exactly, and you see, folks like us, Paxos is a stablecoin issuer, becoming a national bank as well as a trust bank as well as a New York trust bank, because we do see obviously a future where CBDCs are important, and they most likely do work with private entities, to get that from the U.S. government to the end consumer and businesses, right? To get the digital currency. I think
maybe one thing that's quite interesting to call out is given I feel that there's such a proliferation on experiments, like the Angle Labs are doing now. It's effectively the free market's attempt at creating stability or a money. Yeah. And so clearly there's going to be incredible amounts of innovation. There's going to be a lot of copying. There's going to be a lot of cloning, a lot of forking in, forking out. It's just going to be the way it is. I would say that maybe it's not necessarily a prediction, but I think because of how easy it is to clone, fork in, and once a stability design really proves to work out, you're going to see just aggressive competition, and actually it will probably head towards community and brand alone, and we'll probably head to a very bizarre scenario, I think, where whilst you don't need goodwill in the trustworthiness of a brand, because that's just in principle not obviously the system itself is what you're trusting and it's working, it's not the brand, but I think you'll see competition over the brand being potentially more important than the underlying mechanism itself.
That makes sense. Indeed. Julien, a prediction or thought on sort of what we're looking forward to?
Yeah, I'll take a European-focused vision of the world for this one. So in this region, we're starting to see negative interest rates, which is quite crazy for people. It's mostly for people that have high balances in their bank account, but who knows where we're going. And so on the decentralized world, we can either get pretty nice interest rates or actually get a synthetic equivalent of the euro or the Swiss franc without the negative interest rate. So I think this will make the stablecoins increasingly appealing to users, and they will want to get access, not just for speculation, just to not lose money.
Great, Gustav, your prediction or thought, and yeah.
Very quickly, I think in like the next 5 years, we will see like the biggest players in DeFi, you know, like Aave, Compound, and Maker, be the biggest financial institutions in the world. That's it.
Exciting. I'd love, you know, on what metric. We'll have a lot to think about. But
we will choose the metric.
We will choose the metric.
My money's on Dogecoin. I'm sorry.
Yeah, there we go.
Yeah, we'll really appreciate you know, everybody's time and contribution. Unfortunately, we didn't get to audience questions, but you know, we're all pretty publicly available. So if you folks who have been listening do have questions, please do reach out. I'm at mdudas on Twitter. Maybe everybody could give their primary way they can get reached.
I'm Pablo Veyrat on LinkedIn. Oh no, on Twitter too. Sorry.
Arentoft on Twitter.
Yeah, I'm Freddie Farmer on everywhere pretty much.
At Julien Thevenard as well for me.
Excellent. Thank you so much.
All right.
Thanks,
Awesome. Thank you much, everyone, guys.
Bye. Thank you.
Thank you so much, Mike, Pablo, Freddie, Gustav, and Julien. I mean, what I learned is buy Doge, but hopefully those 4 sessions of the last 2 days have sated your appetite for DeFi. If not, let us know on our socials, and we'll make sure to pack even more for the next event. Now, the last panel before lunch, we'll go down the rabbit hole on a topic we've touched on a little bit previously, and that's governance. In particular, how can decentralized autonomous organizations, otherwise known as DAOs, encourage participation from their token holders? This is the Open Web Forum at CogX, curated by Fabric Ventures, and I'll see you back here in 19 minutes.